The first Monday of August opened with a massive wave of euphoria on Wall Street. The Dow broke 53,000, and the S&P 500 rallied right to the edge at the new all-time high. Investors were trading on a wave of geopolitical relief. Over the weekend, the United States officially called off planned military strikes against Iran, signaling that new peace talks would begin immediately. The moment the threat of a wider conflict faded, global crude oil prices plummeted by nearly 5%. For Wall Street, cheap oil means lower inflation, which means cheaper borrowing costs for corporations. But while U.S. traders were busy celebrating cheap energy, the Asian tech markets were collapsing. In July, South Korea's benchmark KOSPI index dropped 22%. It was the worst single month for that market since the 2008 financial crisis, wiping out an entire year of gains in a matter of weeks. The U.S. market is trading on a macro-political victory, completely ignoring a microeconomic disaster that is currently ripping through the global technology supply chain. South Korea is ground zero for this financial earthquake. This chart shows the KOSPI's recent performance. The steady upward climb fractures in late July, dropping 10.8% in a single day. Below the trend line, we see what accelerated the crash. Over 1 trillion won in debt-fueled retail investments wiped off the board. This was triggered by forced liquidations. When retail investors buy stocks using borrowed money, they have to maintain a certain account value. If the stock price drops too far, the broker automatically sells the shares to recover the loan. That automatic selling drives the price down even further, triggering more liquidations. The primary victims caught in this doom loop were the country's foundational semiconductor companies. Samsung Electronics fell roughly 12.5%, and memory chip maker SK Hynix tumbled right alongside them. Because those two hardware giants account for more than half of the KOSPI's entire weighting, their localized sell-off dragged the entire national market down with them. Samsung and SK Hynix manufacture the physical memory chips and hardware powering the global AI industry. Their sudden collapse is a blaring early warning siren for the biggest tech giants in the United States. To understand why the hardware suppliers are crashing, we have to look at the U.S. hyperscalers, the massive tech monopolies actually buying the chips. This diverging bar chart illustrates the core financial disease infecting the AI boom. On one side, you have what these companies spend on AI infrastructure. On the other, you have what they actually make selling AI products to customers. We saw this math play out in real time during Alphabet's second quarter earnings. Cloud revenue grew quickly, but they spent $44 billion on capital expenditures in a single quarter. That massive infrastructure bill pushed their free cash flow into the negative. Combined, projected infrastructure spending from Microsoft, Meta, Amazon, and Alphabet is on pace to cross $1 trillion by 2027. Analysts estimate a $600 billion annual gap between what these hyperscalers spend on servers and the actual revenue the AI ecosystem generates. Now, institutional asset managers are actively trying to calm the market. They argue that this volatility is just a temporary shift in sentiment and that the long-term growth trend for AI remains firmly intact. But the underlying unit economics of AI are currently broken. The revenue isn't catching up to the spending, and retail investors in Asia are panic selling out of fear that the money is about to dry up. Which brings us back to Wall Street. The U.S. market is dangerously elevated on geopolitical good news, ignoring the structural rot at its core. U.S. tech giants cannot sustain $1 trillion in infrastructure spending indefinitely. Eventually, the software they build has to generate enough profit to cover the cost of the servers they run on. If shareholders force Microsoft, Google, or Meta to slash their AI budgets to protect margins, the Asian hardware supply chain will be obliterated. We saw a similar dynamic during the late 90s dot-com bubble. The internet was a real technology with real customers, but the financial expectations and capital spending got years ahead of economic reality. So, is the U.S. stock market just enjoying a temporary sugar high? Or is the historic crash in South Korea the definitive proof that the trillion-dollar AI bubble has finally popped?